Hi guys, it's Stock Curry, and today I'm going over the 3 stocks that I bought in the Millionaire Club portfolio last Friday. These are stocks that are undervalued, following the same strategy Warren Buffett used to become a billionaire. So let's get into it. Now, if you're new to this channel and you're not familiar with the Millionaire Club portfolio, this is a portfolio that I started at the end of last year. And what we're doing is we're depositing $250 every other week, or $125 per week, whatever's easier for you. And this ends up maxing out what would be a Roth IRA here in the United States. And by putting this money in and just putting that money in every single year and then growing it by buying value stocks, we're hoping to get the same sorts of returns that Warren Buffett got when he first started, where Warren Buffett was averaging about a 30% annualized return for his first 15 years. And if we are able to accomplish that and average a 30% annualized return for the next 15 years, this portfolio will become $1 million within the next 10 to 15 years. So that's the goal. That's what we're going for. We're using the exact same strategy that Warren Buffett used when he first got started, which is buying undervalued stocks and then holding them. Now, the one difference is Warren Buffett had this belief that you should just hold for basically forever, although he has been known to sell some stocks when they become overvalued. And we're making a slight change to this based upon another billionaire value investor who is John Templeton. And he had a very similar strategy to Warren Buffett. The one difference is Warren Buffett would sell after stocks became extremely overvalued after many, many years. John Templeton would sell once the stock got to fair value, and then he would use that money to go buy another undervalued stock. So that's the one slight change we're making, is we're following a little bit more of a John Templeton approach, where we're selling these stocks once they get back up to fair value. So let's take a look at the portfolio. There's actually 4 stocks I need to discuss with you, and then I'll talk about the 3 that I actually bought. As of the recording of this video, the portfolio is at $5,697.45. That includes $16.99 in cash. And I did make another $250 deposit into this account. Overall, we are up about 4% year to date. As you can see, we have 22 stocks in the Millionaire Club portfolio. Some of these stocks are down and some of these stocks are up. But overall, we're still up about 4%. Now, before I get into the 3 stocks that I bought last Friday, I want to talk about one of these stocks, and that is GT, which is Goodyear Tire and Rubber. You'll notice on GT, we're down about 9, almost 10% on the stock from where we bought it. And what's interesting about GT is that it's currently at fair value, meaning it's at a PE of 15. Now, when we bought the stock, we were actually buying it undervalued. The PE was about 8, and now it's 15. So how is that possible? Well, what ended up happening was they had a horrible earnings. And that really bad earnings last quarter caused the average PE ratio to go up, because as earnings go down and the share price stays the same, your price to earnings ratio goes up. And so the PE ratio on GE rose to 15 because of a really bad quarter. So now the question becomes, do we sell it? Do we hold it? What do we do? And in this particular case, I am personally making the decision to hold it. Following a little bit more of that Warren Buffett approach of just buying a good company and then holding a good company, even if the share price goes down, even if they have 1 or 2 or 3 quarters that are bad. And so I'm personally making the decision to hold it at this time. However, if you wanted to sell it and get rid of it because it's at fair value, that would make sense as well. And so that's why we are actually down 10% on that stock, even though the stock is at fair value. is because of the really bad earnings brought the overall PE ratio down. And that is probably going to become a fairly common theme this year as we enter a recession. These companies are good companies, but as we enter a recession, their earnings are going to go down, and a lot of these companies are going to become fair value or even overvalued, even though we're down on the stock. And that's okay. That happens during recessions. So long as you buy a good company with a strong balance sheet, they got plenty of cash on hand to weather a recession, you're going to be just fine. And so in this particular case, a lot of these stocks that are going to start dropping, we're just going to hold. And I do believe we're going to be just fine, because once we get out of this recession, these stocks should absolutely skyrocket. And that's really what we're doing right now. We're buying, we're dollar cost averaging in, we're adding to the portfolio positions, knowing full well the stocks are probably going to go down. We're just adding in because we don't know which are going to go down and which are going to go up. But by slowly adding in, once we get through this recession and the whole market starts to rise in about a year or so, our portfolio should take off massively and rapidly, because generally coming out of a recession, it's these undervalued stocks and these small cap stocks that usually recover the fastest. So that's really the goal of the portfolio at this point going into a recession, is just to find really good companies with strong balance sheets and continue to buy those. And that leads us into the 3 stocks that I bought last Friday. Now, the first stock I bought, ZIM, I got 4 shares of that. And this stock was actually something called a DRIP, or a dividend reinvestment purchase. ZIM had a pretty big dividend. And so what we did is just took the dividends from ZIM and reinvested it by buying more shares of the company. The other 2 were true dollar cost average in based upon the $250 deposit from 2 weeks ago, and that was BHF and QFIN. Now, there's some pretty interesting financials on these, which I'm going to get to in a minute. But first of all, I just wanted to let you know that if you want to buy these stocks while the market's still open, and you want to know when we actually place the trades rather than waiting days or even a week later to find out about them on YouTube, you can follow me on Twitter, where I post the trades within minutes of making the trades, at twitter.com/RealScottCurry. That's twitter.com/RealScottCurry. All right, let's get into the details on the 3 stocks that I bought. The first stock was ZIM. And ZIM just had a really large dividend, which now gives them an annual dividend yield of 129%. It's crazy to think about, but we can literally hit a 30% profit on ZIM just from the dividends alone, even if the stock price stays flat. So ZIM is really in a special situation case where the 30% growth won't necessarily come from the rise in the stock price. It could just come from the dividends. Still, ZIM does meet the qualifications for the Millionaire Club portfolio because it is a value stock. It has a PB, that's price to book ratio, of 0.44, meaning you're currently able to buy ZIM for less than half of the value of the assets. So ZIM would have to more than double in price before it got back up to fair value. The next stock I bought was BHF. This is Brighthouse Financial. Now, as you can see here on the chart, as with all financial companies last month, this stock got absolutely clobbered with the bank collapses. Now, being a bank, we're also going to use the PB ratio, or price to book ratio, to value this particular stock. And BHF currently has a PB ratio of 0.48. So just like ZIM, it is currently trading at less than half of the value of the assets. Now, the one thing that is very concerning about BHF is the fact that it no longer has a PE ratio, or price to earnings ratio. And that is because they now have a net loss for the year. Their earnings per share over the last 2 quarters were absolutely dismal, and BHF lost a lot of money. Now, had BHF been a stock that I was looking at for a buy for the very first time, I would never have touched it because they're losing money going into a recession, which is not good. So why would I buy more if they're losing money? Well, the reason really has to do with where the bank sector stands right now. And the last few quarters were terrible because banks had really high increase in the cost of their labor. But once JP Morgan Chase came out and gave their earnings, and we showed that banks are now showing huge increases in profits due to the fact that interest rates have gone up so much. All of those huge increase in labor costs are now priced in. And I am essentially betting that the increase in interest rates is going to make up for that increase in labor costs, and that BHF is going to be able to get back to profitability. Still, the fact that they did have 2 unprofitable quarters in a row makes BHF an extremely risky stock to buy into. And this could actually continue to go down. There's no guarantee this is going back up, even after that major sell-off last month. So BHF is ultra high risk, probably the highest risk stock we have in the Millionaire Club portfolio. So I just wanted to let you know about that this one is not going to fall in line with your typical Millionaire Club buy because of the fact they're now losing money. So that's one thing about these stocks. You've constantly got to be monitoring them because a profitable company that's doing great could flip and become unprofitable at any moment. The question we really have to ask ourselves, especially as we enter a recession, is do we think the company will be able to weather the storm? Will this company be able to get out of the recession and become profitable over the next 2 or 3 years? And that is a decision you're going to have to personally make on every single stock you buy. But it's the biggest thing that you need to be thinking about as we enter this recession is which of these stocks is going to be able to weather the storm. There's a very good chance the Millionaire Club could have a loss this year as later in the year we go into a recession. But my bet is that over the next 2, 3, 4, 5 years, those losses are going to not only be made up, but we're actually going to beat the overall S&P market. All right, now let's get into the third stock that I bought last Friday. And this is a company that's doing quite well that remains undervalued. And that is QFIN, which is 360 DigiTech. 360 DigiTech is a Chinese company. And it's one of the reasons why I've really held off on dollar cost averaging into them. But I took a look at the PE ratio and it's still extremely undervalued. It's a PE of 5, sector average of 19. This stock is trading at about 25% of fair value. This stock could easily 4x over the next few years. And so even though it's a Chinese company, I felt fairly comfortable dollar cost averaging into them, especially since I've never dollar cost averaged into the stock. And it was becoming a very small portion of the portfolio. And I felt like it was time to go ahead and add on some more shares now that we've had a little bit of a pullback. So that's what I bought in the Millionaire Club portfolio. Obviously, things aren't quite as rosy and easy as they were earlier this year or even at the end of last year. Now that the Federal Reserve is expecting a recession to start later this year, it's going to get a little bit more difficult for these companies to maintain profitability, and it's going to get a lot more difficult for this portfolio to actually show a profit this year. But that's okay. Even Warren Buffett had losses certain years when he was first getting started. His average still was 30% because he had quite a few years with 50, 60% gains. And so even if we do take a loss this year, I still think it's going to be okay because I think we'll be able to make it up in the years ahead. Keep in mind, we're still up 4% for now. We'll just have to see if we can maintain that profit or if we end up with a small loss this year. So if you guys want to join us, now is an incredible time to start buying into the Millionaire Club portfolio, especially as the market is expected to go down later this year as we enter a recession. The stocks that we're invested in are getting really, really cheap. And you have an opportunity to buy in at prices even lower than where I bought in at, meaning you could actually see an even greater profit in your portfolio than I see in mine. So if you want to join us in this Millionaire Club portfolio challenge and come and make money with us, I would recommend you go open a new broker account, set it aside so that it's specifically for the Millionaire Club portfolio, and get some free stocks while you're at it. Those free stocks are a great way to kickstart your portfolio. You can get up to $10,000 in free stocks. If you are interested in that, you want to get a kickstart to your portfolio, some free stocks, and get a separate portfolio you can set aside for the Millionaire Club challenge, I would recommend you go check out the platforms that have those free stock offers on my platforms page at stockcurry.vip/platforms. That's stockcurry.vip/platforms. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they can start making money in the stock market as well. And don't forget to hit this like button and subscribe. And if you missed the buys we did 2 weeks ago, make sure you watch the last video that I uploaded here.